Hello, everyone, and welcome to today's BMA webinar dealing with standard costing. This is Nick Katko from BMA, and the first thing I'd like to do is to make sure that technically everything is fine. And so, can you see me? Can you hear me? Can you see my screen? If a few of you can answer in the question panel, that would be good. All right, great, thanks. All right, I started a few minutes early just to make sure that everything was fine there. All right, so let's get started. I know some people will be joining. We'll take care of all the administrative tasks first. So first of all, in your control panel, there's a copy of the presentation in the handout section. Please feel free to download it. And if you're watching a recording of this, please email me and I'll be glad to send you a copy of the presentation, or if you forget to download it also. If you would like to ask any questions, please put them in the question panel. Hold on, I'm just checking something. And we'll try to get to some questions during the polling questions and also at the end. All right, if you are a, excuse me, a certified public accountant in the United States and you would like to get 1 hour of continuing education credit for this webinar, please answer the 3 polling questions, stay logged in to the event, and at the end, send me an email. I'll be glad to send you a certificate. And anyone else, if you'd like just a certificate of attendance, I'll be glad to send it to you. This webinar is also a little preview of an online workshop I'm going to be doing in August, solving the standard costing problem. I've done this workshop over the past couple of years online. It's 3 1.5 hour sessions on August 10th, and between each session is 90 minutes with a little break in between. And what we will do is go into a lot more detail about how to deal with standard costing in a lean company. It's a very interactive workshop. If you'd like to register, there's the registration information, and I'll repeat that again at the end. All right, so that takes care of all the administrative work, and let's talk about what we're going to discuss today. So first, I want to introduce what the issues are with standard costing. Then we're going to look at methods to simplify standard setting, methods to help eliminate unnecessary ERP transactions, and lean inventory valuation practices. Excuse me. What I'd like to say is that this is very much a process, okay, of dealing with standard costing in a lean company. I look at it as a long-term process, not a short-term process. And like everything else, when it comes to lean, you have to have a plan in place, and you have to work the plan. And what I'm going to be sharing with you are things that I have done personally, both as a CFO and working with companies and taking them through the process. And I think that's really what is important to understand here. The issues that we're going to be discussing today have to be addressed. Okay, if you have a standard costing system in your lean company, it's inevitable that you're going to have to deal with these issues. And so I really think it's important at the beginning of the lean transformation process to understand what the issues are, especially if you're in accounting and finance, because you will probably have to lead the company through dealing with these issues. So let's start, and a brief introduction. Standard costing systems are deeply embedded in companies. Okay, and this picture sort of, I tried to summarize how deeply embedded standard costing systems are. If we start at the bottom, they're used for performance measurement. That's things like variance reporting and absorption. They're used to analyze profitability. That's the idea of having a product cost and being able to understand the profitability of a product, the product line, things like that. The role of accounting. You know, accounting is sort of the caretaker of the standard costing system, and it impacts the work in accounting. And you know, you have people that are called, for example, cost accountants. Inventory valuation, which is really the prime purpose of a standard costing system, and this is used for financial reporting purposes. And quite frankly, standard costing sort of automates the whole process. You know, you have the product costs, you report production and cost, and then you report the items that are sold, and the standard costing system in conjunction with the ERP system does a nice job of valuing inventory and cost of goods sold. Then there's, on the right side, there's production reporting. Okay, you have to report production in order to make these transactions happen. Okay, you have to release work orders, report against work orders, close work orders to get the numbers into the system. And finally, there's the setting of standards, okay, which is another job primarily of accounting and finance. And so what we're going to focus on today is really the inventory valuation, the production reporting, and the setting of standards. The analyzing profitability, performance measurement, that's pretty much covered in things like the lean accounting box score and performance measurements, value stream income statements. In the workshop, we will address those issues, but in today's webinar, we're just going to focus on how to deal with inventory valuation, production reporting, and setting standards. So one approach, let me put all this up at the same time. One approach to dealing with standard costing system is sort of a lean approach, that there's waste, and we want to eliminate the waste and improve the system, okay? And you know, here's the typical 8 wastes of lean using the acronym of downtime. And so you have to sort of think of dealing with standard costing as through continuous improvement. So for example, defects, okay? You know, in a lean company, standard costing information doesn't work well. It's not relevant or reliable. So the idea of lean accounting box scores replaces the standard costing information and eliminates that waste. You have overproduction waste. Information that is produced and not used. I worked with a company last year, did some online work with them, and it started with the director of operations who basically said, accounting sends us all this information, we just ignore it. That's overproduction waste. Then there's the waiting time, okay? The long feedback loops between when something happens and when the information is available. A lot of times this is like a monthly cycle. You get your variance reports and absorption reports, and by the time you get those reports, the information is not useful anymore. There's the neglect of human talent. And this is basically means that the work that people are doing is beneath their talent levels. And if you think about cost accountants, for example, this one company I'm working with, a very sharp, talented accounting person, and he spends all his time being what I call an Excel jockey. He's just dealing with information. He's taking information out of the standard costing system, creating massive spreadsheets, trying to analyze data. And that's not the best use of his talent. The transportation waste is handoffs of information between systems and people. So you just think about, you have shop floor reporting that goes into the ERP system, then you have extraction from the ERP system into spreadsheets to do analysis. All those handoffs are not, they're forms of waste. There's the annual setting of standards and rates. That's a batch process, okay, done once a year. Then you think about the human motion, unnecessary searching for information. You think about all the meetings, all the questions about all the standard costing information. And finally, then there's the excess processing, all the detailed transaction reporting and stuff. So, if you really want to begin addressing the issues of standard costing in your company, start it from a waste approach. And these are some examples. Okay, so now let's get into it. So first, let's talk about simplifying standard setting. And so this is, again, think of this as a process, okay? In a current state or in a traditional standard costing system, you have a lot of detailed rates that you set up and data that you set up to create an accurate product cost for analytical purposes. Now, in lean company with lean accounting, we're not using product costs anymore. We're not using absorption numbers or variance numbers, okay? But we still need to have standards to value inventory, okay? We still have to do that for financial reporting purposes. And so the shift in thinking here is that, all the details all the detailed data that you set up that creates standards, we don't need that detail because we don't need the alleged accurate product costs. What we need to do is we just need to focus more on inventory valuation at a macro level. And there's one analogy of standard costing is that it's like spreading peanut butter on a piece of bread, and you can spread it out, but it's just a matter of moving numbers around. And so the idea here is to simplify standard setting and eliminate some of the unnecessary detail so that you still get an accurate inventory valuation, but you're not too concerned with each individual product cost. So first, let's look at the bills of material. So, think about this from the point of traditional drivers of complexity to lean drivers of simplicity. So first of all, the number of bills of material. So in traditional manufacturing, each item that has to be reported as inventory. such as a subassembly or finished goods, it needs a bill of material. Okay. Now, in a lean system where you have improved flow, you may not be reporting those subassemblies as inventory because they're all being made to order. So in that case, there's the opportunity to eliminate those subassembly bills of material and just incorporate those subassembly components onto a finished goods bill of material. The number of parts and line items in a bill of material. For material control purposes, MRP planning and purpose and purchasing, okay, everything is listed on the bill of material. Why? So the system can tell people when to buy, okay, and also to calculate allegedly calculate an accurate quantity on hand. So that's how it's used traditionally. In a lean company, you have pull systems and visual controls that are controlling your material quantities and movement. And so there's opportunities to eliminate or reduce the number of line items on bills of material. Quantity per assembly. Again, the traditional drivers of complexity are to get an accurate product cost or purchasing, okay? And sometimes the quantity per assembly includes like a yield factor, okay? And why is that done? Well, you know, you want to put in a scrap factor so that MRP can say when to buy more. Lean drivers of simplicity, just what's the actual quantity based on the product design? And finally, there's the cost of the material, you know, using, you know, what's the standard cost? And that's important to calculate for variance analysis. Whereas simplicity, from a lean viewpoint, just use the average cost. So, you know, what the point of this is really what must be in place in order to simplify bills of material. So here are some improvement opportunities, okay? And you have to think of this as, you know, we have to have things in place. When we have things in place, we have opportunities to improve. So as you create pull systems, you can reduce the number of bills of material by eliminating, for example, subassemblies. Now, in certain cases, custom products, you know, require a bill of material, and in some cases, your ERP system could do one-time configurable bills of material, which you can actually produce as you go, rather than setting up and maintaining this massive quantity of custom bills of material that you only use maybe one time. The line items on the bills of material. Okay, you know, you have purchased items, you have subassemblies. Now, you can eliminate the subassemblies, as I mentioned. There's also, you have to look at those bills of material and think about what's on there. For example, especially if it's used for purchasing requirements, some companies put everything on there. You know, they put very low value items just so that purchasing is automated. You can possibly switch to expensing some of those items as consumable supplies and get them off the bill of material. Third, quantity per assembly. As I mentioned, we have yield rates that get factored in so that we can automate purchasing and understand quantities on hand. Just use the actual quantity used per the engineering design. And finally, the price of the item. As opposed to determining a standard, just use the last price paid or an average. And a lot of times in your ERP systems, this is possible to do. Just change the setting. So simplifying labor and overhead rates. Now there's a lot of complexity here. Okay, and again, it's based on the premise of an accurate product cost. So the number of rates, okay, detailed product costing by work center. Okay, you want to get into, you want to rate a labor rate and maybe even an overhead rate for every work center in your factory. Okay, and again, detailed product cost is why we want it. But if we have value stream income statements and we're looking at value stream costs, that is how we're controlling costs. We're not controlling costs with the product cost. So there's the opportunity to reduce the number of rates. The run rate, okay, the run rate is how long does it take to produce the product, or what's the run rate in any work center. There's a lot of analysis done on that to maximize absorption. For example, a lot of companies, you have the run rate and they put the setup rate in there to maximize the absorption. And this is also used for capacity planning. Again, what's the run rate? Just put in a simple average. We're not concerned with a detailed product cost. We're concerned with just inventory valuation in total. The number of work centers and router steps. Again, this is for production control, detailed product costing, and variance analysis. That's why there's a lot of details. With pull systems, you can reduce the number of work centers and router steps because everything is flowing faster. And then the number of routers, again, each item that is reported as a sub-assembly or a finished good must have a router. And again, much like the bills of material, you can eliminate the sub-assemblies and just have routers based on finished goods. So improving labor and overhead, let me put all these up. You know, you can reduce the number of routers to finished goods only. You can reduce the router line items, okay? As opposed to each production step, just reduce the number of steps. You're not concerned about reporting actual. You're not concerned about looking at, you know, each specific step in the router. How did it perform? The goal would be to have a router line item of 1, make the product. The run rates, again, what's just the actual cycle time per the value stream map? Forget about trying to maximize absorption or including setup. And then rate setting, minimize your rates and your cost allocations. The ideal, you have 1 labor rate for your factory, 1 overhead rate for your factory. Again, we're just trying to get a macro inventory valuation. We are not focusing on detailed product costing. So that wraps up the first section, and let me launch this first polling question, which is attendance check number 1, and I'll give you about 30 to 45 seconds to answer, and I just want to see if there are any questions, and I don't see any. Okay. If you want continuing education credit, please make sure to answer these questions. All right, I'm going to close the poll. I'm not going to share the results. All right, so let's move on to transaction elimination. Now, you know, ERP systems, they're very complex, okay, but they're necessary. Here's a different way to think about ERP systems. It's just a big calculator, okay? It reads information from tables, it reads information from transactions, and it does a whole lot of math to create standard costs to variances and things like that. Now, this is an eye chart, okay? It's very complex, but ERP systems rely on what's called transactional control. And if you think about this, the idea is that, you know, we create all these reporting requirements with the idea that the system, we can look into the system and we can understand problems and issues. We get quantities on hand. We get all this information out of the system, but it requires a lot of transactions to be put in the system. And all those are the ones that are highlighted in the circles, okay? Now, here's the problem, and I'll mention this a few times, is that the flow of transactions has to match, for everything to be accurate in an ERP system, the flow of transactions has to match the flow of the material movement. And that just doesn't happen. The other issue is quality. People inadvertently make mistakes. They forget to enter transactions. They type in the wrong numbers, for example. They forget to barcode something. You know, they forget to report their time. And I'm sure that if you deal with this, you know what I'm talking about, because the information just sort of comes up and it has to be fixed. Okay? And a lot of people have to spend time fixing it. So, you know, so this is the current state. Now, here's the beauty. In a lean company, lean controls, which are pretty much visual, replace the need for transactional control. So, and everything in all the lean controls are visual. Okay, you have supermarkets that tell you exactly how much to make to fill up the supermarket shelf. You have pull systems. You have FIFO lanes. All this is designed to control production. It tells people what to work on next. It gives them the priority of what to work on, and it manages flow. Pull systems also limit inventory, the amount of inventory in the system. Then you have things like, you know, daily huddles, performance measurements, Gemba walk, standard work, standard levels of inventory. So all of these lean controls replace the need for transactional control. So this presents another opportunity. Now, again, you know, you have to have these controls in place, but if you understand your lean operational transformation, you can actually create a plan to reduce the number of ERP transactional controls. Let me give you an example. Work orders, okay? You know, the work order, I like to call the work order like the Swiss Army knife of an ERP system, because it does a whole lot, okay? And it's really a control. It really creates the transactional control, because, you know, work orders are issued. You have to report transactions against the work orders. You have to close work orders. And so, you know, one opportunity and it's a great opportunity as pull systems get put in place, is to reduce work order transactions. So here are some opportunities, all of which can be done. First, stop reporting actual to work orders. Okay, you have lean performance measurements in place. You have visual controls in place. You don't need to be reporting actual, because all actual does is create the variances. Okay, especially reporting actual labor time. And I always tell companies, tomorrow you can stop reporting actual labor time to your work orders. It's not going to impact anything but the variances. There is in most ERP systems something called backflushing. Many of you may already be using this. Okay, and this is where we don't have to report at every I'm going to show you an example of this in a minute. You don't have to report at every step in the process. Why? You have lean performance measurements in place. You have visual controls in place. That is controlling production. And so we're also flowing material faster. So backflushing reduces the number of transactions that have to be reported. I mentioned earlier reducing the router steps, okay? And this applies to work orders too. The fewer steps on the work order, on the router, the fewer transactions. And again, basic visual production controls replace the need for all the router steps. The idea would be to get to a one-step router. Okay, make the product. Now you can also decrease the number of work orders. Okay, the idea is instead of having work orders go to every single cell or work center, tell them what to do, have the work orders attached to the sales orders. And also, if you have fewer sub-assemblies, you have fewer work orders. And just remember this, you know, anything you can do to reduce work order transactions is going to simplify work for operations. It's going to free up some capacity. It's going to simplify work in accounting, and it is also going to eliminate the possibility of making errors. So here's a simple example of backflushing. So if you think about, on top is the traditional job step reporting. We have 12 transactions. We have 10 production steps. We have to also open the work order and close the work order. So here we have 12 steps, transactions have to be reported. Backflushing is simply identifying a few specific steps where you are going to basically report completed work. And what happens there is, you know, you have to open the work order, you have to close the work order. So what you would do, for example, you would report production in step 3, and the system also makes the assumption that step 1 and step 2 were completed. Then the same thing in step 5. And then when you, for example, when you close the work order, the system automatically assumes steps 8, 9, and 10 are also completed. So, in this example, as opposed to having 12 transaction reporting steps, you only have 5. And, if you can't reduce the router steps, you can do the backflushing. And this is very, very effective. And like I said, it frees up a lot of time. So that's the work order transactions. Then you have material control. And some of this is somewhat related to bills of material, but it's also related to this idea of the ERP system being able to track quantities on hand and anyone being able to look in the system to do some of these tasks. For example, you know, MRP telling purchasing what to buy, and maybe also automating the purchase order process. Determining what orders to ship. Okay, if you have a lot of finished goods inventory, you got to look in the system, say, oh yeah, these orders are completed, or we have finished goods, we have to allocate the finished goods to certain orders. Where to find items. Okay, if you have a lot of inventory, you might have multiple inventory locations. And where is this part? You look in the system. Where to store items. Okay, again, you're trying to put stuff in, you have multiple locations. Where do we put it? The status of work in process and the status of orders. Okay, that's, you know, where is this product? When is it going to, where is this order? When is it going to be done? So you need a lot of transactions, which I showed in that original traditional ERP flowchart, to keep all this on track. The idea is to have an accurate quantity on hand so we can look in the system and know. But as I mentioned earlier, the flow of transactions and the quality of transactions does not keep up with this, and it creates a lot of work. What's the work? You have work like you have a lot of receiving inspection work. You think about all the material movement and the people that are basically involved in material management. Think about all the transactions that have to be reported. I mean, if I'm moving material to this location, I have to report it to that location. Now, I might forget to do it. I might put it in the wrong location. There may not be room in the original location, and I have to put it somewhere. So all this creates a lot of problems. What does it lead to? It leads to cycle counting. It leads to inventory adjustments. So here's the idea. You know, and this is a repeat of a slide. Visual controls limit the quantity on hands. Visual controls allow people to see what needs to be worked on. So what are some things that can be done? You can start a supplier certification program. Okay, you do this with your good suppliers that are reliable, and you focus them on, you know, that you have good quality, good delivery, short lead times. You might even have point of use delivery, okay, where the supplier, as opposed to going to receiving inspection, they deliver to, for example, welding or assembly. And that's sort of like the idea of, you know, in the grocery store or the supermarket, where the vendors come in and they just stock the shelves. Okay, that's the concept. That limits the inventory. You can also do vendor managed inventory, where the vendor, you know, maybe it's not at point of use, maybe it's in one location, and then as you pull from the vendor managed inventory, that signals the purchase, and you just pay based on what you pull. And then the vendor fills up the inventory periodically. So we limit the inventory, we reduce the need for inventory adjustments and cycle counting. Now, you know, this has a great benefit in operations, because all the people that work on these tasks, they can now be reassigned to more value-added activities. All right, so let's do attendance check number 2. Alrighty, I'm going to close the poll. All right, so let's move on to the third part, excuse me, lean inventory valuation. This is basically another way to think about this is turning off standard costing. You know, as I mentioned, standard costing does a good job of valuing inventory for financial reporting purposes and cost of goods sold. But it requires everything we've talked about. It requires a lot of detailed setup. It requires all those tables to be set up. It requires the transactions. So this is an opportunity. And I talk about it third because as your pull systems mature, as your inventory comes down, this creates an opportunity. And it is a tremendous opportunity that I think that lean companies, and especially the accounting and finance people in lean companies that have inventory, need to focus on early in the lean transformation process because of the great benefits that accrue. Okay, now I was fortunate enough in my CFO job at Bullard to be able to do lean inventory valuation. It was something that I did in cooperation with, I led the effort, but it just seemed like the right thing to do because we didn't have much finished goods inventory and it didn't matter. In fact, our finished goods inventory at any point in time was what was sitting in shipping that was going out the next day. We didn't stock anything. Everything was make to order. I've been able to work with other companies, both large international public companies and smaller private companies on lean inventory valuation methodologies, and it works. And every company I've worked with, it has been successful. Sometimes it takes a little more time than others, depending on the issues involved, but it does work. And again, it's a great opportunity. So why is this possible? Well, the first thing is, you know, inventories go down because of lean practices. And when you get to about 30 to 60 days, it opens up the opportunity for lean inventory valuation methodologies. Now, if you have more than 60 days, it's still possible, but I sort of just set that up as a general guideline. The reason you can do this from a financial reporting viewpoint is that the financial risk of misstating inventory is a lot less because you have a lot less on hand. You can't really misstate profits. As I mentioned, you know, we only had at Bullard, our inventory was what was sitting on the dock going out the next day, which was maybe, I don't know, 5%. I don't even remember. It was maybe 5% of total inventory. Okay, so you know if you got it wrong, you're not going to, at the end of the month, you're not going to misstate the profits. So you can use simpler methods to maintain compliance with GAAP or IFRS. And I just want to make a note here that, you know, generally accepted accounting principles do not state that standard costing must be used. I've actually read the principles. I've written some articles about it. Standard costing is not an inventory valuation method for financial reporting purposes. What generally accepted accounting principles say is that because it recognizes that inventory valuation is difficult, you have this continuous nature of manufacturing where products are being made And they might be made in 1 month and sold in the next month, even if it's a lean company. Prices change, things like that. So it's very difficult to get true actual costs of any particular item in inventory. So what generally accepted accounting principles say is we're going to use cost flow assumptions, and these are listed here. And what I really want to point out is that lean inventory valuation uses the average cost method, where inventory and cost of goods sold are at some average cost. Okay, and that's what the inventory valuation method that you use, the cost flow assumption, is a change in accounting principle. And if you're audited, it has to be disclosed, but it's not that big of a deal. When I did this at Bullard, I had our outside auditors involved in the process, and they were involved in the process from the beginning in order to come up with the method that they can test. And they said, yeah, sure, this is great. And yeah, it's just a simple disclosure in the financial statements. So again, if you're in accounting and finance and you want to move to lean inventory valuation, get your auditors involved. So let's look at some averaging methods. So if you think about material, okay, how do we get an average? Now, material is sort of a different animal than the production costs, the labor and the overhead. It really depends. I like to counsel companies on how many parts items do you have. If you have few raw materials, you might be able to understand your quantity by just doing a monthly physical. And you can understand your average cost by using your value stream income statement. But that's not really the case with most companies. I found most companies have lots of items, lots of SKUs. So the most logical thing to do is to continue to track your quantities in your ERP system, okay? It doesn't make sense to get out of your quantities to go to something else, because it would just create chaos in terms of quantity on hand. So your averaging method is on the price or the cost. Use an average cost, use a last price paid. Now you have an average material cost per item. And as I mentioned earlier, you may be able to change your ERP system and the configuration to make that happen. Now the production costs, getting an average. Now this is really where the benefits are in lean inventory valuation. Think about all the detailed rate setting, the transaction reporting, and things like that. As I mentioned earlier, we're getting away from an average product cost. We're getting away from detailed labor and overhead cost to an average product cost. So how do we average? Well, if you have a value stream income statement, there are your actual costs for the period. Okay, that's easy. We want to capitalize using some averaging method. Capitalize total cost, not inventory product, not each individual product. We want to use a journal entry. Now, the great part about this is you set your labor and overhead rates to 0. And as I mentioned earlier, get your auditors to buy in on this. At Bullard, we set our labor and overhead rates to 0. I've worked with, Parker Hannifin over the years, large international company. They actually went almost factory by factory. This factory was on a lean inventory valuation method because they had low quantities on hand. Other factories maybe weren't as lean. They stuck to standard costing, and it all worked. And the auditors bought into it. Okay? You have to create a method to do the averaging. Let me show you a simple example. This is something called, we're gonna average based on units. So we have total production costs, 876,550 in step one from the value stream income statement. We produced a total of 22,861 parts for the period. So the average production cost per unit, $38.34. So what do we do in step three? We know our quantities on hand at the end of the period. And now, we're doing materials still in the ERP system. So the raw material doesn't get any labor, doesn't get any capitalized production costs. The work in process is about 50% complete. So you take the 3834, multiply it by 3,430 units, multiply that by 50%, you get the 65,758. You take the finished good quantity times 3834, you get the 175,341. So you have what your ending production costs need to be on your balance sheet, 241,098. You know what your beginning production costs are from the prior period. So you simply make a journal entry where you're going to credit inventory and debit the income statement for $55,411. And it is that simple. Now, there are other methods you can use. You can use days of inventory, you can use a historical average, but these are just two. This is one example. So what do you have to do? First, stop capitalizing labor and overhead by product. Simplify the method to capitalize material costs. Maybe use just average cost or last price paid. Determine the best method for your company. This is something you sort of have to test and experiment. For example, in your ERP system, if you have what's called the test database, or a sandbox or a playground, you can go in there and try different inventory evaluation methods. Test and experiment, try things out. Work with your auditors. All right, so let's do attendance check number 3. Then we'll wrap things up. And I'm going to look at the questions. All right, I'll give you a few more seconds to answer. All righty, I'm going to close the poll. All right, so let's wrap things up. So think about this as a transformation process. Okay, you have a current state. You have your management accounting system and your standard costing system are sort of integrated into one. Okay, one system. So in the near term, future state, you want to eliminate standard costing from your management accounting system. And that's the idea of, creating box scores and lean performance measurements. And that's your management accounting system where you're analyzing performance, you're understanding profitability using different numbers, but you're still using this standard costing system to value inventory because you have to, and you still have a lot of inventory. So in that case, in this situation, this is where you apply lean to the standard costing system. Simplify the standard setting, start working on reducing transactions. That's sort of your near-term future state. And then you can get to your long-term future state of eliminating standard costing or moving to lean inventory valuation. So that's the process. The process works. I guess, you know, the smaller the company, the easier it is. The more larger the company, the more complex this is, but have a plan. And if you have a larger company, you know, you want to work this from sort of the CFO position down. So here's a little bit of reality check. Standard costing in lean companies. You know, the standard costing information is not compatible with lean. Okay, and if you are a manufacturing company and you use standard costing, it is inevitable that you are going to have to deal with this. Okay, and my advice is start planning early. Okay, don't ignore it. And you know, accounting needs to be involved in this. If the company leadership and lean leadership understand this, but accounting doesn't, you got to sort of train and educate accounting on this. As I mentioned earlier, separate your management accounting system from your inventory valuation methods. Those are two systems, not one. That's an important way to think about this to be able to make progress. And I can't stress enough the opportunity in accounting to eliminate a great deal of non-value added work by even simplifying standard setting, reducing transaction elimination, and then especially lean inventory valuation. Think about this. You have people that might be cost accountants or cost analysts. They're actually going to become lean accountants because they're going to be freed up of all that work that really is beneath their skill level, and you can apply their great analytical skills to participating in improvement events, being part of huddles, and driving better profitability analysis using lean accounting. So here's some upcoming events. You know, we're doing this Solving the Standard Costing Problem workshop on August 10th. There's where to register. And I encourage you, especially if you're trying to deal with standard costing in your lean company, we're going to do a whole lot of exercises. We have examples of analysis, doing it standard costing wise, doing it lean accounting wise, and how you get different answers. And it helps you put together a plan. We have monthly webinars in August and September. Please register for them. We have our monthly lean accounting community chat, which will be this Thursday. Register once, you get one Zoom link for all the remaining monthly webinars. Then we have Lean Leadership Week coming up in September. There's a lot of events there. They've actually just announced that it's going to be virtual, not on site. And so go to this website. I'm going to be doing some workshops, pre-conference workshops, and a couple other speaking events if you're interested in that. All right, so let's see. Just had one question. You know, for someone who is not much exposed to an MRP system, any special tips for them so that they can work together with the internal team? I think, you know, the best way to deal with MRP is to understand the lean controls and how they are better than MRP controls. And, you know, you have to be able to show the benefits of pull systems and visual controls, and then that reduces the reliance on MRP. Again, this is a sort of longer term process. All right, so that wraps things up. Thanks a lot. If you have any questions, please contact me. Remember, if you'd like, please complete the survey. That's going to pop up here. If you want continuing education credits or certificate, contact me, and I look forward to seeing you online in our future events.